Hello, I'm Tim Beggins, president of Elk Trading Company. In today's article, natural gas and LNG, this week's main drivers and the look ahead. In this week's article, we've got an image from the EIA showing the weekly natural gas storage report, which came in at plus 76. This was above expectations. It almost matched the 5-year average, which was plus 75, but it is bullish relative to last year. Natural gas and LNG markets navigated a week of competing bullish and bearish signals as traders balanced summer weather, LNG growth, geopolitical developments, and quarter end positioning. This week's main drivers: the July contract expiration and the holiday trading. The expiration of the July NYMEX contract and the upcoming July 4th holiday weekend contributed to heightened volatility and position squaring across energy markets. Number two, heat arrives, but demand remains uneven. Above normal temperatures are building across the south, boosting power burn demand. However, key population centers from Chicago through New York City remain relatively mild, limiting nationwide cooling demand. Meanwhile, France and portions of Western Europe are experiencing record-breaking heat, increasing power consumption and supporting global gas demand. Number three, Strait of Hormuz slowly normalizing. Vessel traffic through the Strait of Hormuz continues to improve following recent disruptions. While shipping flows are gradually returning to normal, market participants remain sensitive to any renewed geopolitical tensions, given the region's importance to global LNG trade. Number four, LNG feed gas demand improves. Golden Pass LNG continues progressing toward commercial operations, with Train 1 now operating above 50% utilization. Growing LNG feed gas demand remains one of the strongest structural supports for U.S. natural gas balances. And number five, competing generation sources are capping demand. Strong renewable output, healthy nuclear availability, and coal generation continue to offset some natural gas demand in the power sector, despite rising summer temperatures. The look ahead. The global LNG market increasingly appears focused on winter risk. European winter spreads remain in backwardation, discouraging aggressive storage injections even as inventories slowly climb toward 50% full, with only 4 months left remaining in their injection season. At the same time, uncertainty surrounding the timing of Qatar's full export normalization is supporting winter LNG pricing. Spot LNG cargoes economics continue favoring Asia, creating additional competition for European buyers. Weather remains a wild card. While concerns over developing Super El Nino are tempering expectations for a severe winter, history reminds us that polar vortex disruptions can still occur under El Nino conditions. And finally, the Atlantic hurricane season has started quietly. However, the peak months of August through October remain directly ahead for Gulf Coast LNG facilities and natural gas infrastructure. As we move into July, the market's primary focus remains unchanged: weather, LNG exports, European storage progress, and geopolitical stability. Let us know your thoughts in the comment section below. Please hit that like and subscribe button. Thanks for listening. We'll see you soon.